Are we reliving 2008 or is it just me?
A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
Okay, it's not as bad as 2008, but three of the biggest banks just fell this past week. Silicon Valley Bank being the second largest in America for the bank to fail. Signature coming in at third, and Silvergate. Signature and Silvergate both being crypto banks, but Silicon Valley Bank was the biggest bank out of all of them. Funded a lot of tech startups such as Roku. What demise became of Silicon Valley Bank? Why did they fail? Well, they had a lot of depositors' money, and we live in a fractional reserve banking, which the bank does not need to have 10% or more of your deposit. Say for example, you put $10,000 in a bank. US law allows a bank to hold $1,000 or less of your money in the bank, and then it can use $9,000 of your 10 grand to lend out to other people, such as personal loans, mortgages, and credit cards. Kind of surreal if you think about how the banking system works, right? So what did Silicon Valley Bank do with depositors' money? Well, they invested in treasury bonds, which are considered pretty safe. They invested in treasury bonds at a 1% interest rate real back. So you get a lockup of 5 years in the bonds, and then you can sell it with an annual return of 1%. Treasury bonds are not a good investment when the federal is hiking up the interest rates rapidly. So when Silicon Valley Bank invested in treasury bonds at a 1% interest rate with a 5-year lockup, and the Fed increasing the treasury bonds to a 5% interest rate, Silicon Valley Bank got stuck at 1%. So now their treasury bonds that they invested in were losing money. So while Silicon Valley Bank invested in treasury bonds too, they were also experiencing run on the bank. All these people that wanted their money all at once, which actually increased the bank's failure. Secretary Janet Yellen said that the Silicon Valley Bank was not going to get a federal bailout. That only the depositors were going to get a bailout.
Bloomberg also reported that the CEO of SVB Bank, Gregory Becker, sold $3.6 million of stock the day before the company collapsed. What exactly do you think occurred here?
Silicon Valley Bank CEO Greg Becker sold a bunch of stock the day before the collapse. So like they say, the rich people always get bailed out first, right? But what are you saying? Isn't the bank's FDIC insured up to $250,000? Yes, but like I said, a lot of depositors at Silicon Valley Bank were tech startups. 93% of the depositors at Silicon Valley Bank had more than $250,000. So the US government came in and bailed out this bank and the depositors. So a lot of these companies needed their money to make payroll and pay their employees. So it does have a domino effect on the economy if these high tech startups cannot pay their employees. They also built a $25 billion fund just in case other banks fail. They have $25 billion in funding that they just approved in case of other banks' failures. According to President Joe Biden, says taxpayers won't be used to bail out SVB Bank. So I guess the US government just prints money out of thin air, right? SVB Bank is coming back and reaching out to their clients that deposit money to another bank. As in here, Charlie Bilio's tweet, Silicon Valley Bank is urging customers to help them rebuild their deposit base by transferring back deposits that left over the last several days. I guess they are now lower risk than JP Morgan with new and existing deposits fully protected by the FTC, regardless of size. So situations like this makes you think, is my money safe in the bank? Kind of scary, right? Well, if you enjoyed this video, please hit the like button, subscribe to the channel, and I'll see you on the next one.